Two people walk into the same building at 6:30 in the morning. Same glass doors. Same security desk. Same elevator ride to the top floor. 5 years later, one of them is quietly worth millions. The other is gone. Burned out. Replaced. Welcome to life inside a hedge fund. At a distance, hedge funds look simple. A group of smart people. A pool of money. A mission, beat the market. But up close, it's less like investing and more like a pressure system. Every level you climb changes how you think, how you work, and what you're actually risking. And the strange part, the higher you go, the less control you actually have. Let's start at the bottom. You're 22, maybe 23, fresh out of university, top grades, maybe an internship that didn't sleep. Your title is Analyst, which sounds impressive until you realize your job is to be wrong. A lot. You wake up before sunrise. You read everything, earnings reports, macro data, obscure industry blogs. You build models that try to predict the future using spreadsheets that break if one cell is off. You think in percentages. You speak in probabilities. And every day you pitch ideas. Buy this stock. It's undervalued. Short that company. It's overhyped. Most of your ideas go nowhere. Some get ignored. A few get tested. And one, if you're lucky, gets turned into a real position. That's when it gets uncomfortable. Because now it's not just a model anymore. It's money. Real money. Someone else's money. And if you're wrong, nobody cares how good your logic sounded. A few years later, if you survive, you become an associate. This is where the game changes. You're not just finding ideas anymore. You're defending them. Senior investors start asking sharper questions. What are you missing? What if interest rates move? What if you're early? And being early is the same as being wrong. You realize something most people never see. In hedge funds, being right isn't enough. You have to be right at the right time. Too early? You lose money. Too late? You miss the trade. Perfect timing? That's where the money is. And timing is the one thing no spreadsheet can guarantee. Then comes the jump. Vice president. Senior analyst. Maybe even a small portfolio. Now you're not just analyzing risk. You are the risk. You're given a slice of capital to manage. Maybe $10 million. Maybe $50 million. It sounds like freedom. It isn't. Because now, every decision has weight. You wake up, and before you even check your phone, your brain is already calculating. What moved overnight? Did something break while I was asleep? Am I about to lose money right now? You start seeing the market differently. Not as charts or trends, but as a living system reacting to millions of other people trying to outthink you. And here's the twist. They're just as smart, just as informed, just as desperate to be right. At this level, the pressure isn't loud. It's quiet, constant. You're judged on performance, but not over years. Over months. Sometimes weeks. A few bad trades in a row, and suddenly your conviction looks like arrogance. Your strategy looks like a mistake. And your job starts to feel temporary. Because in a hedge fund, there's no loyalty to effort, only to results. Climb higher. Now you're a portfolio manager. This is where the money gets real. You're managing hundreds of millions, maybe billions. Your decisions don't just affect your career. They affect the fund, its reputation, its investors, its survival. And the rules change again. You stop asking, is this a good investment? And start asking, is this worth the risk? Because every position competes with every other position. Capital is limited. Mistakes are expensive. And the biggest threat isn't being wrong. It's being wrong when it matters most. A market crash. A sudden rate hike. An event nobody predicted. At this level, one bad month can erase years of good ones. This is where the myth starts to break. From the outside, hedge funds look like places where people beat the market. But inside, it feels more like trying not to lose. Because the math is unforgiving. Lose 50%, and you need 100% just to get back to zero. Drawdowns aren't just numbers. They're survival tests. Investors pull money. Confidence drops. Pressure rises. And suddenly, every decision is made under a clock you can't see. And then there's the top. The fund manager. The founder. The person whose name is on the door. From the outside, this looks like power. Control. Freedom. But inside, it's something else entirely. You're no longer just managing money. You're managing expectations. Investors want returns. Consistent returns. Not just in good years, but in bad ones too. They compare you to benchmarks, to other funds, to promises you made when the market looked easier. And here's the uncomfortable truth. The bigger the fund gets, the harder it is to outperform. Because size limits flexibility. You can't move fast. You can't hide in small opportunities. Every decision is visible. Every mistake is amplified. At this level, the game isn't about beating the market. It's about surviving it, year after year, cycle after cycle, while competitors rise and fall around you. And even if you succeed, there's a strange irony. The more money you manage, the less personal it feels. Because the stakes are too big to treat it casually. Every trade becomes cautious, calculated, sometimes even conservative. The same system that rewards risk, punishes it at scale. And all of this exists in a world that keeps changing. Interest rates shift. Markets evolve. New technologies disrupt old models. What worked 5 years ago stops working. What worked last year might already be obsolete. So the real job isn't just investing. It's adapting. Constantly. Quietly. Relentlessly. From the outside, hedge funds are about intelligence. But inside, they're about endurance. Who can handle uncertainty the longest. Who can stay rational when the numbers turn against them. Who can survive being wrong without losing everything. Because everyone is wrong eventually. The difference is what it costs you when it happens. And that brings us back to those two people. Same building. Same starting point. One of them climbs. Learns the system. Survives the pressure. Manages risk just well enough to stay in the game. The other? Maybe just as smart. Maybe even smarter. But the timing was off. The risk was misjudged. The market moved in a way no model predicted. And in this world, that's enough. We're trying to outsmart you, day after day. How long would you last before the pressure starts making decisions for you? So the question isn't whether hedge funds make money. Some do. Some don't. The real question is this. If your entire life was measured by decisions made under uncertainty, with incomplete information, against POP,